Hello and welcome to the 11th of our CIMA F3 Financial Strategy lecture recaps. This one was on performance measurement. So firstly, our profitability ratios. The first one, return on capital employed, our profit before interest and tax over our capital employed. And remember, our capital employed is our total assets less our current liabilities. So what does this tell us? It tells us the underlying performance of the business before finance costs. The return generated on the investments that we actually have within the business. Gearing is irrelevant because we have left our interest out of it. And it's before tax, which means that we can compare it across tax regimes. Capital employed, as I said, is our total assets less our current liabilities, also calculated as non-current assets plus net current assets, or equity plus long-term liabilities. All of those measurements will give you exactly the same figure if you look at a balance sheet. So do look at one and make sure that you know all those methods of calculating capital employed. So our ROCE was trying to calculate the return on the assets that we have in the business, or the investments. The return on equity, on the other hand, is trying to tell us what return we are generating on shareholders' funds. Okay, so we'll use our top line, profit after tax less preference dividends, i.e. total distributable earnings, over our ordinary shares plus reserves, i.e. shareholders' funds. Okay, so this tells us how well the shareholders' funds are being used. Gearing will have an effect on this ratio, as it should, because financial risk will increase, which should increase the required return by the investors. Remember that everything on these ratios has to be comparable. You have to be comparing year on year or with a comparable business in the same industry. Not useful for comparing returns across sectors. Our asset turnover is our turnover over our capital employed. This tells us how many times we turn over our capital and how many times our turnover exceeds that capital. If it's low, it's likely that we're in a capital intensive business. If it's high, well then we may be a retailer or someone who is not in a capital intensive business, turns over very quickly on small margins, okay, or a standardized product. Operating profit margin, profit before interest and tax over your turnover. This tells us the profit percentage that we're making on each sale that we make. So those are our profitability ratios. On to gearing. Two ways to calculate our capital gearing: debt over debt plus equity, or debt over equity, and we'll be told in the question which one they want us to use. So it contains debt, and that's all permanent debt. Equity, which is the share capital plus the share premium plus reserves. Just a note on preference shares: if they're irredeemable preference shares, you'll have them in as equity. If they are redeemable shares, you'll have them in as debt. Our interest cover is profit before interest and tax over interest. How many times we're able to cover our interest with our profit. And on then to some shareholder ratios, first of which we've looked at before. Price to earnings ratio is our share price over our EPS. What is this telling us? Well, it's telling us our market value to current earnings. It gives us an idea of the market expectations, and that's for the future earnings growth. So what does the market expect this business to do in the future? On to dividends. Dividend cover is profit after tax over our dividends. It tells us the profits actually paid out. The dividend yield is the dividend per share over the share price, and basically tells us how much we are able to yield if we buy that share, how much our yield is likely to be. The limitations of using annual accounts basically to do this, published accounts, are first of all that they're prepared on a historic basis. It's last year's figures, they are historic, so they're of limited value. The accounts also are prepared on an accruals basis rather than a cash basis, so that will also limit the usefulness, and also could be manipulated through different provisions and so on. So that are some of the limitations on using published accounts to calculate these ratios. And that was our lecture on performance measurement.